If you could pick only one fund for the rest of your life, would it be the S&P 500 or would it be the total stock market? Buffett says the S&P 500. J.L. Collins, the guy that wrote The Simple Path to Wealth, says the total stock market. That's the debate at heart of index investing. And there's more. John Bogle, the founder of Vanguard, leaned towards the S&P 500, while Taylor Larimore, the king of the Bogleheads, swears by the total stock market. That's right, even the legends don't agree. So, which one would you pick? Stick with me because at the end of this video, you'll know the answer. And I'll even show you the cheapest way to own the entire US stock market for practically free. Hello fellow compounders, Dennis Chen here, your chief compounder. If you're new to the channel, I'm a former hedge fund manager, CFA charter holder, and Wharton MBA. Today, I run the Always Be Compounding Club, where we teach investors how to grow wealth steadily and confidently for the long term. And in this video, we're tackling one of the most important questions in passive investing. Should you invest in an S&P 500 index ETF or a total stock market ETF? Well, we'll go through the background of these indexes, look at the ETF options, compare cost and sponsors, break down the pros and cons, and even answer what happens if the ETF sponsor goes bankrupt. Then I'll show you a hack for recreating the total stock or the total market using just 2 ETFs, including a combo that gives you the lowest possible expense ratio on earth. And at the end, I'll show you how you can grab a free month of Coffee with the Chief Compounder. So stick around. Before we dive in, a quick but important disclaimer. This video is for educational and entertainment purposes only. It is not financial, investment, or tax advice. All figures and examples are hypothetical and for illustration only. I'm sharing general information and examples, not recommendations tailored to you. Investing involves risk, including possible loss of principal. Past performance does not guarantee future results. Your situation is unique. Always do your own research and consult a qualified financial professional before making any decisions. All right, with that said, let's get started. Segment 1, background of the indexes. The S&P 500 index, launched in 1957, includes 500 of the largest US companies. These giants, for example, Apple, Microsoft, Amazon, Tesla, make up about 80% of the total US stock market. Because it's market cap weighted, the top 10 stocks alone account for roughly 38% of the index. And here's some history. The first mutual fund that tracked the S&P 500 was Vanguard's 500 Index Fund, created by John Bogle in 1976. It was the first true index fund available to retail investors, and it completely changed the investing world. Later, in 1993, State Street launched SPY, the Spider S&P 500 ETF, the very first exchange-traded fund in the United States. The total stock market index casts a wider net. It includes not only those big names, but also thousands of mid-caps and small caps and even micro-cap companies. Depending on the index, it's about 3,500 to 4,000 stocks. And for history buffs, Vanguard launched the Total Stock Market Index Fund, VTSMX, in 1992, giving investors their first chance to buy the entire US stock market in a single fund. Today, its ETF share class is VTI, with over $1.5 trillion in assets. That's $1.5 trillion in assets. So the question is owning the top 80% of the US market enough, or do you want to own the entire 100%? Let's look at the ETFs that let you invest in each. And wait until you hear about one S&P 500 fund that literally charges 0 fees. Segment 2, ETF options. Here are the most popular ETFs for each index. S&P 500 ETFs. SPY, Spider S&P 500 ETF. Its sponsor is State Street, and it's the first ever ETF in the United States, launched in 1993. It has over $500 billion in assets under management and an expense ratio of 0.0945%. It's ultra liquid, but it's pricier than others. VOO, Vanguard's S&P 500 ETF. It has nearly $1 trillion in assets under management, or by now it probably has over $1 trillion, and its expense ratio is 0.03%, 3 basis points. IVV is the iShares Core S&P 500 ETF. It's about $500 billion in assets under management, also a 0.03% expense ratio. SPLG, that's a Spider Portfolio S&P 500 ETF. It's also sponsored by State Street. It's like the little cost cousin of SPY. It has about $30 billion in assets under management, and its expense ratio is 0.02%. That's 2 basis points. SPLG is a cheaper alternative to SPY. And BKLC, that's Bank of New York Mellon, US Large Cap Core Equity ETF. It has around $2 billion in assets under management, and its expense ratio is 0. So it's the lowest cost you'll ever get, 0. Now let's look at total stock market ETFs. We have the granddaddy of total market ETFs that everybody should probably know by now, VTI, the Vanguard Total Stock Market ETF. It has about $1.5 trillion in assets under management. It has a 0.03% expense ratio, and it has around 4,000 stocks. Next we have ITOT, the iShares Core Total US Stock Market ETF. It has around $50 billion in assets under management, and it has an expense ratio of 0.03%. All of these have more or less the same expense ratio. Next we have SCHB, Schwab US Broad Market ETF. It has $30 billion in assets under management and expense ratio of 0.03%. And we have the STPM, the Spider Portfolio Total Stock Market ETF. That's State Street's version. It has $20 billion in assets under management, 0.03% expense ratio, and around 3,800 stocks in their holdings. At first glance, the costs look nearly identical. But once you line them up side by side, the real differences appear. You have the S&P 500 and the total stock market ETFs. Let's compare the historical returns of both. We'll take VOO and VTI as proxies. Over the last 20 years, from 2005 to 2025, the S&P had an average annualized return of 9.8% versus the total stock market had an annualized return of 9.9%. If we look at a shorter time frame, the last 10 years, from 2015 to 2025, VOO, or the S&P 500, had a 12.7% annualized return versus VTI at 12.5%. And over the last 5 years, 2020 to 2025, VOO had a 13.1% annualized return versus VTI of 12.9%. So, what's the takeaway? Over 20 years, the difference is razor thin. Over the last decade, large cap tech dominance gave the S&P 500 a slight lead, and in other periods, small caps and mid caps gave the total stock market a tiny edge. If the returns are this close, then the real question isn't performance, it's the trade-offs. So, let's break down the pros and cons of each. Segment 3, pros and cons. The S&P 500 pros are: 1, they're simple, just 500 of America's largest companies. 2, they're ultra liquid and easy to trade. And 3, they're slightly less volatile. The cons are that: 1, it leaves out small and mid caps, around 20% of the market. 2, it's highly concentrated in 10 stocks, which represent 38% of the index. And 3, SPY is iconic but pricier than newer funds. Now let's look at the pros and cons of the total US stock market. Number 1, it owns the entire US stock market. 2, it captures small and mid-cap growth. And also 3, it's a great one-fund solution. Its cons are: 1, it's slightly more volatile. And 2, the long-term returns are nearly identical to the S&P 500. So it's simplicity versus completeness. But what do the legends of investing say? Spoiler alert, they don't all agree. Segment 4, what the experts say. Even the legends split into 2 camps. Buffett, Bogle, and Malkiel say that the S&P 500 is enough. On the other side, J.L. Collins, Taylor Larimore, and Paul Merriman say that the total stock market is better. So, how do you decide? Before we pick sides, let's answer a question many investors worry about. What happens if your ETF sponsor goes bankrupt? Segment 5, sponsor bankruptcy risk. Here's the truth. ETFs are separate legal entities. Their assets are held by a custodian bank, not the sponsor itself. So even if Vanguard, BlackRock, or State Street went under, your ETF shares would still be safe. Another firm would just step in to manage them. With that myth busted, let's move on to a neat trick. How to recreate the total stock market on your own and do it even cheaper than VTI. Segment 6, how to build a total stock market yourself. If your 401k only offers an S&P 500 ETF, pair it with VXF, that's Vanguard Extended Market ETF, to recreate the total stock market. BOO has the large caps, that's the 500 largest companies, and BXF has everything outside the S&P 500. And the mix, put 80% in S&P 500 and 20% in VXF. So here's the cheapest way to build this portfolio, the total stock market portfolio. Use BKLC, which has an expense ratio of 0%, that means zero, and BXF with an expense ratio of 0.06%, weighted at 80/20, and the blended cost will be 0.012%. That's 1.2 basis points. That means that for every $10,000 invested, you'll be spending $1.20. That's basically free, even cheaper than VTI's cost of 0.03%. So, should you pick the S&P 500, the total stock market, or the do-it-yourself blend of the total stock market? Let's wrap it up. Segment 7, my recommendation. If you want maximum diversification in one ticker, go with BTI, the Vanguard Total Stock Market ETF. If you want to follow Buffett or Bogle, stick with the S&P 500 ETF like VOO, SPLG, or BKLC. And if you're a fee hacker, build the total stock market yourself with BKLC plus BXF for the lowest cost possible. Either way, you're choosing a proven low-cost compounding machine. But the truth is that the real win isn't about which ETF you pick. It's about staying consistent. Sticking with your plan through the ups and downs of the market is what separates successful investors from everyone else. And that's exactly what we focus on inside the Always Be Compounding Club, helping you stay disciplined, consistent, and focused for the long term. It's my private online community where we build portfolios, talk strategy, and support each other through the market's ups and downs. Members also join me for live Q&A sessions in Coffee with the Chief Compounder. And here's your chance. Try it for free for 1 month with the code ONEFREECOFFEE. So grab your free coffee, join us, and let's build wealth together. So, S&P 500 or total stock market? Buffett and Bogle say S&P. Collins and Larimore say total market. And me, I say either one works. The real win is keeping it simple, keeping it low cost, and most importantly, staying consistent. That's the secret. Remember, the key to building wealth is to always be compounding. See you in the next video. Take care.